Liz, what we're seeing right now, this pullback, you think is just a correction in a bull market, and it's a necessary one. Why is that?
I do think it's a correction in a bull market. And I also want to not overly dramatize the correction that's happened. We're really only down 1.3% on the week. We're down 1.4% on the month. We're still up for the year in the S&P. So when you look at just regular expectations for an equity market and what we would see on an annual basis, we're still on track to post high single-digit returns, even if nothing happens for the rest of the year, if we stay flat for the rest of the year. And that's okay. I think we're suffering a little bit from recency bias and looking at 2020 and the amazing momentum that we saw in the stock market in 2020. 2021 is really more about the economy. And as we know, the stock market always leads the economy. So what we're seeing now is this economic momentum that has to confirm the stock market movement that already happened. We also can't have it both ways. We were worried about this a few months ago. Things were too frothy, valuations were too rich. All we did was go up every day for seemingly no reason. We were worried about that. And now that we're having these little corrections and a shakeout where some of the excess is falling out of the tree, we're worried about that too. I don't think we need to worry about it as much as people are expecting.
Although you have seen some pretty significant moves, and if you're talking about a transition, you're talking about a transition from what to what. The NASDAQ has been incredibly strong, a lot of the stay-at-home stocks, a lot of the big tech stocks. You think we're going to transition away from that leadership and that there could be more pain to come for those stocks?
Yeah, I think naturally as we move through the year, as the economy gets healthier, we're going to continue to see the 10-year Treasury go up. We're going to continue to see pressure on those long-term growth stocks. But when we talk about a rotation, I think it's really overdone to keep talking about this rotation from growth into value. I think investors have just started looking for growth in different places. And there's this sort of assumption that growth stocks mean high beta stocks or that they mean high risk stocks. And actually, if you look at the high beta ETF versus the low volatility ETF, the high beta ETF continues to outperform. Even this month, it continues to outperform. And actually, the two biggest sectors in that ETF are financials and energy. So that's actually a pretty value-heavy ETF. So I don't think we have to think about it as just this rotation out of risk appetite. I think risk appetite is still pretty healthy in the market. It's just a matter of we're not going to see this really concentrated leadership by only big tech names. You're going to see this leadership broaden out, and it already has. You'll see leadership broaden out throughout the rest of the year, and some of these pullbacks are a good opportunity to make sure that you're diversified into those other sectors.
Liz, we talked to J.J. Kinahan earlier from TD Ameritrade, and he said retail investors that he's been watching have been showing a little bit of signs of nervousness. They've been selling some of the stocks that have performed really well and moving that money not into other stocks, but into fixed income. What would you say to people who are doing things like that?
Well, I think it really depends on what parts of fixed income you're moving money into. I think corporate America is very strong. It's going to continue to be strong through the rest of the year, and earnings should come in well. So if you're moving that money into some corporate credit, I think that might be a good opportunity. If you're looking at the Treasury curve because you're nervous, yes, it's okay to have some allocation there, but I still think that the risk is to the upside in yield. So I don't know that moving a ton of money into fixed is the right place to do that right now. I do still think there's plenty of people staying in equities. And as long as the 10-year stays at this level and moves up in a more understandable fashion or a softer fashion and not this huge spike up, I think we can do fine in the equity market.
Shepard Smith here. Thanks for watching CNBC on YouTube.